Hi, I'm Jeff Vogan and it's Tuesday. That means it's Tip Tuesday. Today's tip is about a risk people forget to think about all too often, and that's sequence of returns risk. Now, a lot of people know about market risk, they know about interest rate risk, they know about economic risk that might affect investments, but it's the sequence of returns that really counts when you're nearing retirement or are already retired. Let me just give you a case in point. For example, if you retire today and start using your money to live on and the stock market crashes 50% like it did the last two times, right at the beginning of retirement, that's a bad sequence of return, isn't it? Last time the market went down 50%, it took 5 years for the market to get back to even. The time before that, it also took 5 years to get back to even. Do you have that kind of staying power while the market is down to be depleting your assets to live on while the market is down? Now, on the contrary, what if you retired 10 years ago, right after the stock market bottomed out in 2009 and had nothing but upside to look forward to while you're using your money? You're probably in a pretty happy, a lot of peace of mind with that scenario. Yet, in a year or two, maybe the market will correct again. It's a lot better to have those corrections long after you're retired when you've had a time to build more retirement cash up than right as you start. Just because the stock market averages X, say 10% a year, doesn't mean it's going to average 10% every year. Just because the bond market over time has averaged 5 or 6% a year, doesn't mean the bond market is going to average anywhere near that on a year-to-year basis. When it comes time to retire, it makes sense to start removing some of those assets off of the risk, off of those assets that have risk from a year-to-year basis, and putting them in something safer. I mean, even cash and CDs are safer than a stock market investment that goes down 50% or even 20% for that matter. It even is better than a bond that, because of Fed rate interest hikes, that you could lose 1 or 2 or 3 or 5% that year on bonds. Even better, indexed annuities. Might want to consider that, or indexed universal life insurance policies that can go up 5, 6, or 7% on average, but never go down in a bad year. That might be an alternative to put some safe money aside in those indexed products that are insured and secured against loss, while the stock market may be in a correction mode. So again, remember, sequence of return risk really matters when you're retired. Maybe not so much while you're working, but it really does when you're retired. And if you're getting to that point where you're almost retired or are already retired, it may be time to move some of that money off of risk and into those safer investments so that sequence of return risk doesn't come and blow up your retirement plan. If you have any questions, please give us a call. We'd love to talk to you about your risk and what exposure you may have to the market, what alternatives there are for you to protect your retirement.